Trading is often seen as a battle of charts, numbers, and strategies, but the truth is the market is as much psychological, it is technical. Many traders spend years chasing the perfect strategy, but fail to realize that profitability isn't determined solely by indicators or secret formulas. It is rooted in psychology. The way a trader thinks, reacts to wins and losses, and manages discipline often makes the difference between blowing an account and building wealth. The most profitable traders are not immune to fear, greed, or doubt, but they master these emotions in a way that keeps them from interfering with their decision-making. Their psychology shapes how they manage risk, stick to plans, and stay consistent over the long term. To succeed, one must not only adopt strong technical skills, but also cultivate the mindset that thrives in uncertainty. In this guide, we'll explore 6 key psychological traits and practices that separate average traders from highly profitable ones. Point 1. Discipline over impulse. When it comes to trading, discipline is the foundation that holds everything together. Without it, even the most sophisticated strategies collapse under the weight of emotional decision-making. Profitable traders understand this truth, which is why they prioritize self-control and consistency above all else. They know that every trade they take, every risk they accept, and every plan they follow is a test of their discipline. Many beginners believe that trading success comes from finding the perfect system. They hop from one strategy to another, chasing after signals and indicators, hoping to stumble upon a method that will guarantee profits. But the reality is that no such system exists. Markets are fluid, unpredictable, and filled with uncertainty. The true edge lies not in the strategy itself, but in the trader's ability to follow it with precision, even when emotions scream otherwise. Impulse is the enemy of discipline. Impulse makes a trader chase after a rapidly moving candle, jump into trades without confirmation, or increase lot sizes after a win, believing they are invincible. Profitable traders resist this temptation. They understand that the market will always be there, and another opportunity will always come. Patience, not urgency, is their weapon. To cultivate discipline, top traders create detailed trading plans that define entry rules, exit rules, risk limits, and position sizes. They treat these rules as laws, not suggestions. This eliminates guesswork and reduces the influence of emotions. When the plan says, no trade, they don't trade, no matter how enticing the chart looks. When the plan signals an exit, they get out, even if greed whispers that the price could go further. Discipline also shows itself in risk management. Many traders fall into the trap of revenge trading after a loss, doubling their position size to win back what they lost. Profitable traders avoid this because they know one undisciplined decision can undo months of consistent progress. Instead, they take losses calmly, analyze what happened, and move on. To them, losses are tuition fees for the school of trading. Another aspect of discipline is sticking to time commitments. Profitable traders don't spend every waking hour glued to charts. They allocate specific times to trade, analyze, and learn. By doing this, they avoid overtrading and burnout. Their discipline extends beyond trading screens. It becomes a lifestyle of balance and focus. Perhaps the most overlooked part of discipline is emotional control. Fear and greed are powerful forces that derail many traders. The fear of missing out, FOMO, makes one chase bad trades, while greed tempts one to hold on to long. Discipline is the shield that protects traders from these traps. Profitable traders train themselves to accept uncertainty, detach from outcomes, and trust their process. This kind of discipline doesn't come overnight. It is built through repetition, journaling, and reflection. Profitable traders keep detailed records of their trades, not just to track profits and losses, but to observe patterns in their behavior. Over time, they learn what triggers their impulses and design strategies to counter them. For example, if they tend to overtrade after a win, they may set a daily trade limit. If they panic after a loss, They may enforce a rule to step away for 30 minutes. Discipline also requires humility. Profitable traders know they are not bigger than the market. They don't let ego dictate their decisions. They don't try to force trades or prove themselves right. Instead, they respect the market's power and accept that it will move however it wants, regardless of their wishes. In summary, discipline is the silent force that separates profitable traders from the rest. It is not glamorous, and it doesn't show off like luxury cars or quick profits. But it is the reason some traders survive and thrive while others burn out. Discipline transforms trading from gambling into a business, and it transforms traders from reckless gamblers into consistent professionals. If you want to become profitable, start here. Write your plan, commit to it, hold yourself accountable. Train your mind to obey discipline over impulse, and the market will reward you with consistency over time. Point 2. Emotional control and discipline. One of the greatest differentiators between consistently profitable traders and those who constantly lose money is emotional control. Fear and greed are the two emotions that dominate financial markets. Fear can make a trader exit too early, missing out on profits, while greed can push someone to hold on too long, ignoring risk management. Discipline is the antidote. It is what keeps a trader grounded and consistent. Profitable traders know how to detach emotionally from single trades, focusing on the bigger picture instead of the outcome of one position. They follow their plan, cut losses quickly, and avoid revenge trading. This mindset allows them to stay in the game long enough to benefit from probability, rather than blowing their accounts due to impulsive decisions. I'll expand this into a fully fleshed out essay on emotional control in trading, covering the psychology of fear and greed, how emotional impulses sabotage consistency, real-world examples of traders ruined by lack of discipline, techniques used by top traders: journaling, meditation, trade limits, breathing, the role of patience and long-term focus, why emotional mastery is more valuable than any technical system. Point 3. Emotional discipline, mastering the inner battle. This point emphasizes how the most profitable traders are those who master their emotions, not the market. It explains the destructive role of fear, greed, overconfidence, and revenge trading. It dives into how emotional reactions often override strategy, causing traders to abandon plans. Then it provides insights into building self-control through meditation, journaling, strict trade plans, and practicing detachment from outcomes. It also explains how traders should embrace losing trades as part of the process rather than seeing them as personal failures. Lastly, it highlights resilience, returning to the charts with clarity, not frustration after setbacks. Point 4. Patience and long-term thinking. Patience is one of the most underrated skills in trading. New traders often believe they must constantly be in the market to make money, chasing every small movement and overtrading until they burn out or lose their capital. The most profitable traders understand that trading is not about frequency, but about precision. They wait for high probability setups that align with their plan, no matter how long it takes. This patience comes from a long-term perspective, knowing that wealth is built through consistency over years, not overnight gambles. By focusing on long-term goals instead of short-term wins, traders can avoid impulsive decisions, reduce stress, and steadily grow their accounts. The illusion of quick profits. Many new traders believe they must trade daily to succeed. They confuse activity with productivity, mistaking constant trades for progress. This mindset stems from impatience, the desire to see immediate results. Yet, the reality is that constant trading exposes them to more risk, leading to erratic results and blown accounts. Profitable traders, on the other hand, understand that fewer, better trades yield more consistent results. Why patience wins in trading? Patience allows traders to wait for the right conditions instead of forcing trades. It creates discipline, by aligning actions with strategy rather than emotions. When you are patient, you reduce the risk of overtrading, revenge trading, or reacting to market noise. This is how top traders avoid impulsive mistakes while protecting their capital. The role of long-term thinking. The most successful traders treat trading like a business, not a lottery. They think in years, not days. A trader with a long-term vision does not panic over temporary losses, because they understand these are part of the bigger journey. They evaluate progress over hundreds of trades, not a handful. Long-term thinkers build resilience and avoid the trap of chasing quick riches. Patience in market analysis. Profitable traders spend more time analyzing than trading. They wait for confirmations, multiple confluences, and setups that meet strict criteria. This patient approach ensures that when they enter a trade, the odds are in their favor. It's not about predicting every move, but waiting for conditions where probability supports success. Delayed gratification and compounding. Patience ties directly to delayed gratification. Rather than withdrawing small profits prematurely, disciplined traders let compounding work for them. They know small, consistent gains accumulate into life-changing wealth over time. The mindset of compounding is fueled by patience and a belief in steady growth. Patience with learning. Beyond charts, patience also applies to self-development. It takes months or years to truly understand trading psychology, technicals, and risk management. Many fail because they quit too soon, believing success should be instant. Profitable traders stay patient with their growth, knowing mastery takes time and repeated practice. Building patience as a skill. Patience is not innate. It's developed through habits. Journaling, waiting for setups, practicing mindfulness, and setting strict rules all build patience over time. Profitable traders make patience part of their identity, reminding themselves daily that trading is a marathon, not a sprint. Case studies and real-world examples. Many great traders, from Jesse Livermore to Warren Buffett, credit patience as their greatest edge. Buffett famously said, "The stock market is designed to transfer money from the impatient to the patient. The same principle applies in Forex and other markets." The profitable mindset shift. To embrace patience, traders must shift from a trade-to-survive mentality to a trade-to-thrive mindset. This means focusing less on daily profits and more on building habits that produce consistent long-term results. When you adopt this mindset, trading becomes less stressful and more rewarding. Point 5. Mastering emotional control. In trading, charts, strategies, and tools can only take you so far. What truly separates consistently profitable traders from the rest is their ability to control emotions, especially during moments of pressure. Emotional discipline is not just about keeping calm. It's about building a mindset where fear and greed no longer dictate your decisions. If you can master this, you gain an edge that most traders never achieve. Let's break this down. The nature of emotional trading. When you place money into the market, you are immediately vulnerable. Fear of loss and desire for profit tug at you with every tick. Beginners often feel excitement when the trade moves in their favor, and panic when it goes against them. This emotional roller coaster leads to impulsive decisions like closing trades too early, letting losers run, or revenge trading. Profitable traders understand this pattern and train themselves to avoid it. Fear and greed. The two enemies. Fear manifests in hesitation. A trader sees a good setup but freezes, worried about being wrong. This leads to missed opportunities. Greed, on the other hand, tempts traders to over-leverage or stay in trades far too long, hoping for more profit. The most successful traders develop a mental system to recognize when fear or greed is creeping in and immediately counter it with discipline. Developing detachment. One of the best psychological skills is detachment. Detachment means treating each trade as just one of thousands you will take in your career. No single trade should determine your emotions. Profitable traders don't obsess over being right. They focus on following their system. They know that, over a large enough sample, discipline brings profitability. The role of self-awareness. Emotional control starts with awareness. Profitable traders keep journals, noting not only technical reasons for a trade, but also how they felt before, during, and after. By reviewing these records, they spot emotional triggers. Maybe they take bad trades after losing streaks, or overtrade when they're overly confident. Awareness allows them to prepare mentally and avoid repeating mistakes. The power of rules. Another key aspect of emotional control is building rules that act as guardrails. For instance, setting daily loss limits, maximum trades per day, or only trading at specific times. These rules stop emotions from running wild. Profitable traders respect these limits no matter what their emotions say, because they know breaking them leads to disaster. Training through practice. Emotional control isn't achieved in a single day. It is developed through constant exposure and practice. Many successful traders recommend starting with a demo account or small capital. This way, you face the market without risking your financial well-being. Over time, you learn to desensitize yourself to the natural ups and downs. With repetition, calmness becomes second nature. Stress management beyond trading. Outside the charts, profitable traders also invest in personal routines that support emotional balance. Exercise, meditation, journaling, or even simple breathing techniques help regulate stress. They understand that a clear mind makes better trading decisions. Trading is not isolated from life. If you are stressed or distracted, it will show in your performance. Bouncing back from losses. Even the best traders lose. The difference is how they respond. A losing streak often destroys beginners because emotions push them into chasing the market. Profitable traders, however, see losses as tuition fees paid to the market. They pause, review, adjust, and return with composure. They don't let emotions turn one bad day into a bad month. Building confidence through consistency. Ultimately, emotional control breeds confidence. Not arrogance, but the calm assurance that comes from knowing you have a process and the ability to stick to it. With every disciplined decision, confidence grows. This cycle of control and confidence creates the resilience needed to survive in the market long term. In conclusion, mastering emotional control about taking responsibility for your inner world. The market will always test you, but if you build a psychology that's calm, detached, and disciplined, no loss or win will shake your foundation. Most traders fail not because they lack strategies, but because they cannot master themselves. The profitable ones know that trading success is 80% psychology, and emotional control is at the very heart of that truth.